This training is for industry professionals supporting buyers using the first-generation Homebuyer Community Down Payment Assistance Fund. The goal of this training is to review the product terms, the process for applying, and calling out how this program differs from other down payment assistance. First, let's talk a little bit about why first-generation buyers. As you know, we have had down payment assistance in our market for many years, and it's likely one of the reasons we have one of the highest rates of homeownership in this country. However, we also have some of the highest disparities in this country. The approach that we have used for many years of first-time homebuyer and low to moderate income buyer have not helped to close the racial homeownership gap. So this approach of first-generation buyer is a pilot for us to determine whether or not this is a better use of funds and a way to reach those who have been left out of homeownership. Beyond this, we are also looking at developing more impactful ways and efficient ways of delivering down payment assistance. A few product highlights. So as you know, this product is designed for first-generation buyers. This product did receive $100 million in state appropriation and will reach about 3,000 borrowers statewide. Up to $32,000 of down payment assistance can be used, and the way in which that's measured is 10% of the purchase price. This program became available in June of 2024. This is a glance of the application process that will be reviewed in this training. As you can see, it's starting by reviewing eligibility. We will talk a little bit about the homebuyer education requirements, that buyers are required to have a pre-approval for a fixed-rate mortgage before applying, and noting that buyers should not start shopping until they have been approved for this program. So let's get into these details further. So first, what is a first-generation homebuyer? It's important to note that this is a relatively new concept, and there are some smaller scale programs available in our market. It's important for you to understand that all definitions are not the same, and to be clear about what is the definition for this program. So borrowers and their parents or legal guardians have never owned a home in any country or owned a home and lost it to foreclosure. It's important to understand and to take this definition literal. It is really about ownership interests, not whether or not the buyer benefited from their parents or they themselves benefited from home ownership. So here's a couple of examples. Again, if the borrower or any of their parents or legal guardians owned a home at any time, they are not a first-generation buyer, regardless of whether or not the parent or guardian is living. Another example here that we call out is if the buyer or any of their parents or legal guardians married someone who owned a home, they are not a first-generation buyer. So it's important to keep in mind that this is about ownership interest. And while one buyer must be a first-generation home buyer and a resident of Minnesota, other buyers are only required to be a first-time home buyer. And the definition that is being used for co-borrowers or first-time buyers is no ownership interest in principal residence during the previous 3 years. So again, at least one buyer on the transaction must be a first-generation buyer and a resident of Minnesota, and all other co-borrowers at minimum have to be a first-time home buyer. Let's talk a little bit about borrower income limits. So this program follows the Minnesota Housing Startup Loan Guidelines for 1 to 2 person. This was designed intentionally with the goal of trying to limit confusion. It does differ in the sense that it doesn't adjust for household size, but essentially the income limits are as follows. It's important to note that income can be updated annually and is subject to change. So depending on when you are viewing this training, it will be important to reference the website to make sure that this is the most up-to-date and accurate income limits. Another thing that I want to call out here is that this program uses lender qualified income to determine eligibility. So all borrowers listed on the loan, their qualifying income will need to be at or below the amounts listed here for the 11 county metro, Dodge and Olmsted counties, and all other counties across the state. So for homebuyer education, the first generation borrower is the one who must complete the approved education course. And when they apply for this product or this program, that education has to have been completed in the last 12 months. A couple of important things to call out on this. It's the first generation borrower who must complete homebuyer education, although we strongly recommend that all buyers complete homebuyer education. And then again, in addition to it having to be completed in the last 12 months, it also must be done before they have a purchase agreement. Here is the eligible or approved homebuyer education courses. So buyers may complete either an in-person or live virtual course of Homestretch. Also, some of the homebuyer educators use a curriculum called Realizing the American Dream. That is acceptable as well. The alternative is that buyers may complete the self-guided online course called Framework Homeownership. What is not accepted is Fannie Mae HomeView and Freddie Mac Credit Smart Homebuyer U. I know that these are common in the industry, but they do not meet the HUD housing counseling standard. So buyers are required to use either the self-guided online course Framework or complete the instructor-led course that uses either Homestretch or the curriculum called Realizing the American Dream. Also, just a reminder, I want to say it one more time before we move on. A borrower who completes education after they have executed a purchase agreement are not eligible to apply and will be denied. There are no exceptions. There is no opportunity to change this requirement for any specific buyer. This was written in statute and it is important to be followed. So step 3, get approved for a fixed rate mortgage. So borrowers are required to have a fully underwritten conditional pre-approval. Desktop underwriting is not accepted, and the mortgage itself must be fixed rate and fully amortized, and it has to meet the CFPB qualified mortgage definition. This is allowable for Sharia compliant and I-10 products. But what is not allowable is adjustable rate mortgages, negative amortization, balloons, or interest only. It's also important to call out that non-occupant co-borrowers and co-signers are not allowed. There is a form on the website called Pre-Approval Letter Requirements that I would encourage you to reference so that you ensure that your buyers have the correct information on their pre-approval letter. We do understand that this is a shift and differs in how many programs many DPA program requirements, but it's important to know that 1, we're using borrower income qualified by the lender, so we need to know that that documentation has been thoroughly reviewed. And secondly, this program allows buyers to reserve funds. And so in order to do that, it's important that we have the fully underwritten conditional pre-approval from the lender so that we know that the buyer actually is able to be approved for a mortgage, and we're not locking up funds for buyers who may not actually be able to get that underwritten approval. So once that has happened, buyers then apply to the program. The borrower must complete the application online. Once they are logged in, they will review the eligibility criteria. They'll answer a few questions about their household, which is going to help us tell the story about who is being served. And then they will have to upload the homebuyer education certificate as well as the mortgage underwritten pre-approval. A lot of times we get questions about can the lender or the realtor do this on behalf of the borrower? And our answer to that is the borrower should be the one completing the application online. However, we fully understand that they may need the support of an industry professional, whether that's due to language barriers or technology barriers. So we fully anticipate and welcome you to support the borrower in the online application process. But the borrower is applying, not the industry professional. So once a borrower has applied to the program, applications are reviewed for accuracy by the administrator. Incomplete applications are returned to borrowers with guidance. So for example, if they do not have a fully underwritten pre-approval, that application will be returned to the borrower, who will be given guidance on why it was rejected. Completed applications are assigned to one of 10 DPA lenders on a first-come, first-served basis. It's important for me to just call out that you, as the industry professional, or the buyer for that matter, do not select this DPA lender. This decision is made by the administrator based on capacity, availability, geography, and a variety of other factors. Applications that are complete are assigned weekly, and depending on demand, it may be 2 to 3 weeks before a buyer's application is assigned to a DPA lender. The goal of this program is to process about 100 to 150 complete applications each month. So just to review these steps, in a slower kind of visual process for those of you that are visual learners. Let's just start with the beginning. An eligible borrower completes homebuyer education. They then pick the lender of their choice who helps them complete an application, and they receive an underwritten pre-approval. This is the point in which the borrower goes to the website and submits their application online. Once the application is submitted, within a couple of business days, it is reviewed by the administrator. Complete applications are assigned to DPA lenders on a first-come, first-served basis. Once that application gets to the DPA lender, the first thing that they're going to do is confirm eligibility. This is done by reaching out to the borrower, who then must sign the attestations that they are a first-generation buyer, or for co-borrowers, at least a first-time home buyer. This is also when they sign releases, so the DPA lender can contact the lender, the mortgage lender. Once the borrower has returned the attestation and the releases, the DPA lender will then contact the first mortgage lender, who must get the underwritten pre-approval attestation signed within 10 business days. A sample of this underwritten pre-approval attestation can be found on the website. Once all of that information is received and verified to be accurate, the DPA lender then issues a fund reservation letter to the buyer and their mortgage loan officer. It is very important to understand that a borrower should not start shopping for a home until they have been issued this reservation letter. This is different than many DPA programs that require you to have a purchase agreement to apply. Applications for this program that are submitted with a purchase agreement are extremely unlikely to meet the closing timeline. Files cannot be rushed in order to meet a closing deadline. We must honor a first-come, first-served basis for processing applications. And as I noted a couple of slides ago, it could easily take 2 to 3 weeks before a buyer is even assigned to a DPA lender. So this is not a program that is designed for people who have a purchase agreement in hand and need down payment assistance. This really is a program that is designed to reach those, but without the down payment assistance are unlikely to be able to purchase a home. Similar to a first mortgage, you would never encourage a buyer to go out and start shopping for a home until they have met with a mortgage lender. Thinking about it in that same way, we would recommend, again, strongly, do not apply with a purchase agreement and instead communicate to your borrowers or your buyers and the customers that you're working with once they've got their first mortgage approval, then apply for the program. And once they have the approval for this program and the reservation and letter in hand, they can start shopping. So what does that mean? Once they have the fund reservation, those funds are guaranteed for that buyer for a minimum of 90 days. This means they get 90 days to start shopping. If this isn't enough time, what it requires is the buyer to call and contact the DPA lender, who will then give a 60-day calendar extension, giving the buyer up to 150 days to find a home. It is important to know that if the fund reservation expires, either because the buyer didn't request an extension or because they were unable to find a home in the 150-day time period, they will be required to reapply and start back at the beginning of the process. Because of the underwritten pre-approval, we anticipate a low drop-off rate, and we anticipate that the majority of buyers will be able to find a home within the first 90-day reservation period, and that the remainder who need time will be able to do so with the extension period of 60 calendar days. So let's talk a little bit about, now that your buyer is shopping, what are the eligible properties? So properties are limited to Minnesota. They must be owner-occupied, principal residence, and the buyer must occupy the home within 60 days of closing. This program allows 1 to 2 units, and really it's detached townhomes, condominiums, co-ops, and manufactured homes titled as real property. Even beyond this, shared equity, community land trusts, and other resale restrictions are allowed. One call out is for applications that were submitted on or after August 1st, 2024, there are maximum purchase prices as follows. Similar to income, these maximum purchase prices may change over time. So depending on when you are watching this training, I encourage you to visit the website to make sure that these amounts are still accurate. So let's talk a little bit about use of funds. So as we stated in the beginning, it's 10% of purchase price, maximum $32,000. So any purchases below $320,000 are going to be less. They're going to be 10% of the purchase price. Another important call out is that this program does have a minimum housing ratio that cannot be less than 20% of the buyer's gross income. So that means that at least 20% of the buyer's gross income must be paid towards the principal, interest, tax, insurance plus, so PITI. Similar to other programs, the funds can be used for down payment, settlement costs, and principal buydown. These dollars can be layered with other down payment assistance programs. However, it's important to call out that they cannot be layered with the program offered by Minnesota Housing, called the Minnesota Housing First Gen Homebuyer Loan Program. So while this product can be layered with other DPAs, that is the one exception, and it cannot be used in conjunction with Minnesota Housing's First Generation Homebuyer Loan Program. Another limitation of the use of funds is these funds cannot be used to pay the 3.5% FHA MRI costs. That is not a requirement that is determined by this program, but instead a standard that is set by FHA. So it's important to understand that this is not a source of funds that can be used to pay the 3.5% FHA MRI cost. Further, it cannot be used to pay seller closing costs or cover any value gap. So let's take a look at purchase agreement to closing. So this is an important date or time frame that I want you to pay attention to. So once there is a purchase agreement in place, that purchase agreement needs to be provided to the DPA lender 35 days prior to closing. We are not able to rush closings due to the sheer volume and interest in this program. So this is just an important call out for those who are helping buyers write offers and lenders who are also supporting those buyers to understand that a purchase agreement, loan estimate, the application, photo ID, all need to be submitted to the DPA lender 35 days prior to closing. Once the DPA lender receives these things, they will then issue a conditional commitment. The conditional commitment is valid for 60 days. 10 days prior to closing, additional documents do need to be shared with the DPA lender. As shown here, it's the appraisal, title commitment, homeowner's insurance, and if applicable, the flood certificate and insurance. 5 days prior to closing, you can see that additional documents are required and must be sent to the DPA lender. This includes the CD, the note, the mortgage, and the 1008. This is pretty common for DPA programs, but I think what I want you to pay attention to is the specific timeline and requirements. Once the DPA lender has received everything that it needs, the DPA lender will directly send the closing packet to the title company as well as wire the funds to the title company. Sometimes the question comes up is whether or not these funds have to be advanced by the first mortgage lender, and the answer is no. The DPA lender will again provide the closing packet and wire funds directly to the title company. And then it's loan closing, which means a successful closing for your buyer, and everyone is just thrilled and celebrating. I'm going to call out that on the website, there is a form called Timeline for Mortgage Lenders, which details this out. And I think the biggest takeaway from this slide is really that the purchase agreement and supporting documents must be to the DPA lender 35 days prior to the closing date. And just to review, the commitment letter is issued for 60 calendar days. We do know that the majority of closings will happen well before this, but we wanted to allow for delays, which sometimes happened. I also want to call out that additional time is allowed for renovation and new construction. So this question often comes up as well. What happens if the mortgage lender rejects the contract or the borrower opts to call the inspection contingency? We are not interested in locking people into a purchase that is not in their best interest. So in this scenario, should the borrower opt to call the inspection contingency or the property not meet the standards of the mortgage lender, there is the option to still cancel the contract under the purchase agreement, what's been called out and named in the purchase agreement, and the borrower will be issued a new reservation letter. They do not have to start over. They do not have to get back in queue to apply for these funds. They would be issued a new 90-day reservation letter, and if needed, granted the extension as well. So let's talk a little bit about the product terms and repayment of funds. So in addition to creating access to homeownership, this program also helps increase wealth. It is a zero interest loan that is forgiven annually. So 20% is forgiven each year. There is no partial credit. The annual date is based on the closing date. And essentially, if the buyer remains in the home as their primary residence for 5 years, the funds are fully forgiven. If, however, at any time during that 5-year period, the property converts to non-ownership occupancy, the property is sold, and eligible excuse me, a not eligible refinance happens or foreclosure occurs, the balance that is remaining is owed back. So this is managed by the servicer, but as partners in this transaction, it's important to help your buyer understand the terms of this product and what it means if they don't live in the home as their primary residence for 5 years, or if they attempt to refinance without understanding what is eligible. The most common and acceptable reason for refinancing is to reduce the interest rate on the first mortgage. If a buyer wants to refinance to access equity for cash, that would be considered an ineligible refinance and could result in the balance having to be repaid. So again, just helping your buyer understand what's expected of them and the opportunity for this loan to be forgiven if they remain in the home as their primary residence for at least 5 years. And then also, as we close, I just want to call out the opportunity with this pilot program. So it really is first of its kind statewide program. It is focused on the opportunity to narrow the racial homeownership gap by using a more targeted approach for down payment assistance. We are streamlining the approach with a centralized application. Some of the criteria we believe in the upfront preparation is going to lead to better qualified buyers who are going to be more competitive on the market with that fund reservation. And we anticipate that this program will be available for 18 to 24 months from the launch date, which was June 2024.